Why do some law firm partners have to pay state income tax even if they live in a state with no state income tax? As a law firm partner, you're subject to state income taxes based on two things: your state of residence and your firm's location. On the personal side, if you reside in a state that levies an income tax, then your taxable income is subject to state taxes. If you reside in a state with no income tax, like Texas or Florida, your taxable income is not subject to state taxes, only federal and self-employment. But since you're technically an owner of the firm, you also have to pay your share of the taxes levied on the income generated by your firm in other states. For example, for a partner living in Dallas, Texas, your personal income is not subject to state taxes. But if your firm has offices in New York and California, you will owe taxes based on your share of the income generated in those states. Thankfully, most firms will offer what's called a composite return, where the firm withholds a portion of your pay for state taxes and files one big return for all the partners. This helps reduce tax preparation costs because you don't have to file an individual return in each state where the firm generated revenue. But while a composite return might sound like the obvious choice for law firm partners, it may not make sense in every state. That's because most states tax the individuals in the composite return at the highest personal income rate, which may be higher than the individual's income tax rate had he been filing alone. By filing an individual return in those states, instead of opting into the composite return, you can reduce your tax bill. But keep in mind that your accountant will likely charge you extra for the additional return. So you have to make sure that the tax savings from opting out of the composite warrant the extra accounting fees. Bottom line is this, guys. If you're a newly promoted law firm partner, please consult with a qualified tax professional to address your situation.